Stable financial management in an unstable world. Raise your hand if you think the world is unstable right now. A lot of hands. Has it ever not been? Has it? I don't know. Is it ever been the case that the world is stable? I'm not so sure that there's ever been such a period of parts of it. Anyway, I just wanted to ask that question because we always may tend to think that our world and our period is particularly unstable. There have been lots of periods of instability, and things are always changing. We're always changing every minute, and so I thought as I asked this question about are we in an unstable world, whether it's any different. It's always different, but is it ever stable? Don't know that it is ever stable. Inflation sure doesn't look like it's been through a stable period, does it? Look at the mountain of inflation that we climbed in the wake of the pandemic. So this is where we are now, August of 2025, the latest readings, 2.9%, not too bad. Anybody know what the long-term rate of inflation has been since 1926? 2? 4%? Anybody? It's 2.9%. That is the average rate of inflation since 1926. 2.9% on the dot. And that is where the current inflation rate is. The Federal Reserve might like to get it down to 2%, and maybe they'll get it down to 2%. But we are dead on average inflation. And everybody can see that we've had different components do their thing. Energy prices have been lower recently, right? Gas prices are down. And so that's offsetting some higher prices and other things. Here's this big run up in auto insurance. Is everybody enjoying that? How's everybody enjoying their auto insurance? Kelly? But it looks like it's been moderating some here. The insurance companies have made their adjustments. And of course, inflation really drives that because to fix cars, right, that takes parts, and parts get inflated, and labor gets inflated, and so insurance has gone up. We had this huge inflation in core goods. This is this big post-pandemic run-up in inflation, and it's almost been completely squelched out. Little appearance right there. So the inflation picture actually looks like it's stabilized some. Tariffs on U.S. imports. This goes back to 1900. And you can see that the government was largely funded by tariffs back then. The Federal Reserve and the income tax were implemented around this time period. This is World War II, when tariffs were used again as a method of war. And then this long period of drop in tariffs and the opening of the free trade period, whammo. That doesn't look too stable. And this, of course, caused the big market drop back in April. Anybody remember that? Hard to remember now. But boy, there was a lot of worry when the statutory announcement by the Trump administration was we're going to put 30% tariffs. But here we are on October 23rd. 17.4 is what the estimates of statutory tariff rate is, the average assessed rate. And I think there was news this morning that South Korea is looking at 15%. Did anybody see the news? And there's been some news in China. And so one of the things that people have considered about the stock market is that it was always believed that these tariffs were going to come in. This was a threat, but it wouldn't actually come off. And we'll see. But everybody can see that we're in a tariff period that we haven't seen since 1900. And there are questions as to whether the tariffs will hold up legally. That case is headed to the Supreme Court as to whether the president can unilaterally assess tariffs, because the last time I looked at the Constitution of the United States, it says the tariffs are the province of the Congress. But Congress has ceded its responsibility. Now, you might say these tariffs are going to be devastating for our trading partners and their stock markets. Well, here's the U.S. performance of the United States stock market, 14.6%. This is through the end of September. It's not quite up to date, but it's close enough. The Mexican stock market is up 48%. The Chinese stock market is up 41%. The Canadian stock market's up 26%, and their team won last night. So it's dangerous to make assumptions that the tariffs or any other policy is going to automatically have some effect on equity markets. Look at that. Nothing to sneeze at there, but we're happy that we've put some of this in your portfolio too. You've reaped the benefit of it. Does this surprise anybody? Yeah. Really surprising, isn't it? Those are the numbers. This doesn't look too stable. Consumer confidence. Look how it goes up and down year to year. Big, huge swings in consumer confidence. Really unstable figure. Sentiments of American consumers swing like a gate in the wind. But look at this. 9 troughs in sentiment, including we're October of 2025 in a trough of consumer sentiment. People pessimistic as consumers. The average subsequent 12-month returns of the S&P 500 after it hits one of these troughs is 24.1%. In other words, the stock market has moved in the opposite direction 12 months subsequent to troughs in consumer sentiment. And look at the return from after the peaks, 12 months after the peak, when we have exuberant consumer sentiment, 3.9%. Not horrible, it's not negative, but it's very, very clear that this is what we would call a negative indicator, right? And this is where we are right now, suggesting that we might see further gains in the stock market from here. We don't know. But there's an argument that we might, just based on that number. There's no guarantee. None of this is guaranteed. But isn't that a surprise too? Unemployment and wages. Again, ups and downs. And we can see that we are right now seeing an uptick in unemployment, very slight. And we are seeing a decrease in wage growth since 2022. Look at that, very steady downward slope of wage growth, year-over-year wage growth and unemployment. And so this could pose a real challenge for the country. It could pose a challenge for the administration, and it could pose a challenge for the Federal Reserve, because one of the 2 mandates of the Federal Reserve is to ensure employment. The other mandate being what? Control inflation. But that's the dual mandate of the Federal Reserve, to control for inflation and to control for employment. So we will see where employment goes. Who saw the announcements yesterday from Amazon and from UPS? UPS announced 48,000 layoffs, and Amazon announced 30,000. These are big numbers, everybody. Big numbers. And there is speculation that you know what is having a major effect on the job market? AI. I can tell you that in our office we can, we can kind of do more with it. You agree with that? We can do more. So this is a big question. Will we see an AI-induced job recession? Labor supply. We see a steady, ongoing, multi-year drop since the pandemic in payroll gains. Everybody can see that. Three-month average change. So these are changes in the payrolls, and the gain in payrolls, and clearly job growth is down. This is interesting. This is foreign-born labor force growth, native and immigrant contribution, and native-born in red. And we can see here we are in August of 25, and we have a negative year-over-year change in foreign-born labor force growth, but really a strong part of native-born growth. And that is the goal of the Trump administration. So far, it looks like they're getting that. Don't know what it means. Not too much stability in the federal budget deficit, is there? And we're in the middle of, I think we're in the middle of a government shutdown, aren't we? Is that right? It's just a ho-hum, another day, right? But I think the government is shut down. Or some of it's not. Some get paid, some don't. Everybody can see that this other right here, this is probably some of the tariffs. I think it's $150 billion is contributing to sources of financing for the government, but everybody can see that it's not going to come close, the tariffs, to being able to fill our budget. The deficit, $1.8 trillion. Income taxes provide $2.6 trillion. Payroll taxes, $1.7 trillion. And here are the uses of our budget. Non-defense discretionary. We'll see how much DOGE was able to eliminate of this particular category, but it's approaching $1 trillion. Defense approaching $1 trillion. Other mandatory, I don't know what that is. Medicaid, $656 billion. 1.1 trillion on Medicare. Social Security, 1.5 trillion. And net interest on the debt. And the debt is here. I'm sorry. The debt is 2025. It's about there. And this must be what it's projected to be. So we're pushing toward 100%, 120% of GDP represented by our federal debt. Are there other countries in the world that have such high levels? Anybody know? Yeah, Japan is like 200%. And somehow they get by with that kind of debt load. It's a different country, though. We may not be able to tolerate that much. Here's a slide on AI, and everybody can see, look at this, ramping up. It's an exponential ramp up. This is billions of dollars being spent by the major AI hyperscalers. Who knows what a hyperscaler is? It's the big data center people. They're talking about hyperscaling data centers, because all this computation of the questions that we're asking of the AI require data centers and processors, especially processors made by NVIDIA. We put that in your portfolio, about a year ago, because we felt like that was an important company to hold, and it's done well. But NVIDIA is not really building the data centers. They're actually doing a lot of the financing of the building. But the Alphabet, Amazon, Meta, Microsoft, Oracle, these companies, and many more are involved in building data centers, and it's causing enormous demand on power in this country. And you can see that we are estimating, so this is 2025, $350 billion in capital spending this year, $350 billion on data centers by just these hyperscalers. And then the next year, 422 and 467. I mean, you add it all up, this is enormous. Trillions of dollars in investment going into data centers for artificial intelligence purposes. And you can see here, U.S. industrial production of high-tech industries. This goes back to 2014, and you can see that in purple, and communication equipment, computer equipment, semiconductors, these things really have taken off here in 2020 to 2025. You see that they have far surpassed all industry excluding high tech, and that this has become a major growth of our industrial sector. Our industrial sector. When we talk industrial, we're not really talking John Deere anymore, are we? We're not really talking, factories stamping out widgets. We're talking data center production and creation. So, is this a good thing? Is this a bad thing? Are these people idiots? Do they know what they're doing? And then this is from 1 year ago, not 1 minute ago. We showed you this slide 1 year ago. Goldman Sachs, our competitor, said the S&P 500's decade of big gains is over. A year ago they said that. Maybe their clients missed out on this year in 2025, but I'm happy to say that we have kept you all invested and been able to give you returns, and we'll see where we go from there. So, we have been climbing a wall of worry. And so here is the climbing, right? Here is the climbing, and here we are on October the 23rd of 2025 on the S&P 500. We use the S&P 500 as a proxy. It's basically the US market. 22.5 times earnings is where we stand. We can see this, who knows what that is? This big downdraft here. Say it again? April. Yeah, April. This was the tariff drop. I remember people were very, very concerned about that back then. But look at this rebound. So we are 22.5 times earnings. That's not cheap. A 1.5% dividend yield. This is valuation of the S&P 500. This line right here shows one standard deviation over the 30-year average, right? So that means anything above this dotted line means we're in a more expensive state of things, right? This is the 30-year average for the S&P 500, 17 times earnings. And this is negative, minus one standard deviation, 13.8 times earnings of the S&P 500. So these periods are in an undervaluation period. We can see that in 2008 especially, 1994. This was the tech bubble, the internet tech bubble back in 2000, and you see that we were around 24 times earnings, and we're not that far away from that. This was a tech-driven bubble. Remember Cisco Systems, Dell Computer, and MCI WorldCom? Those companies could do no wrong, and they were never going to come back to earth. Amazon was a very young company at that time. Well, the companies, the good news is, are a lot bigger now and a lot more profitable than they were back then. The quality of the earnings this time. So if you had to pose a counter argument as to why these higher valuations are warranted, and I'm not making that argument, I'm just saying these are a lot bigger companies. We have companies, yes, they're highly valued, but they're also highly profitable. NVIDIA will earn $25 billion in the quarter. $25 billion of earnings in the quarter. So when they are going out and saying, okay, we're going to invest $1 billion in somebody else's, data center. We're going to help fund Microsoft, or we're going to help fund Oracle. They got to do something with the money, and so they're basically funding their own sales, right? Because when the data center gets built, whose chips are they buying? NVIDIA's. But $25 billion, $100 billion a year in earnings is simply mind-boggling. So there is that. There's high profitability and we have growth going on. However, as everybody can see from these two slides, this is a scatter plot. These are individual observations dating back, I don't know, many years, 100 years or so. Actually, these may be quarters. These may be individual quarters, but you can see that as the valuation goes up, the trend line of future returns, this is returns on this axis, goes down. And that makes sense. The more expensive something gets, the less you can expect future returns to be highly positive. And you can see this is subsequent one-year returns. The pattern isn't as distinct, right? Maybe we do get some big high returns at this expensive level of the market. But 5 years subsequent, 5-year annualized return subsequent, you see it's much more of a pattern. It's pretty distinct. It's pretty clear. The more expensive a market gets, the less you can expect high returns. Look, these returns all cluster around 0 and even negative. So if you are worried about valuations, you have good reason to be worried about valuations. I'm not here to tell you you don't have good reason. This tells you right here. Index concentration. Right here we can see that the top 10, this goes back to 1996. This is in this reddish color right here, the top 10 market cap, their percentage of the S&P 500. So back in 1996, the top 10 companies, and I'm going to show them to you in a second who they were, accounted for 17% of the S&P 500. Now the top 10 account for 40% of the S&P 500. We have some true giants. Here's 2000, 25%, and then a big peak here in 2020, 30%, but we've now surpassed all of those. And I think this is an all-time record. The top 10 companies, Microsoft and Apple and NVIDIA, et cetera, account for 40% of the S&P 500. So if you buy an S&P 500 index fund, we might even be able to have an argument as to whether it's truly a diversified fund. I had this discussion with a good friend of mine who was an investment banker and knows a lot about finance, and I had to show him that the fund that he was about to buy, which wasn't even an S&P 500 fund, it was a large cap growth fund. The top 10 holdings in that fund, it's a Schwab fund, accounted for 60% of the fund, all in technology. And I said, that's not even a diversified fund. He said, well, I want to put it in a long-term trust for my children. And I said, okay, I mean, maybe it'll do great. I don't know. But I'd be concerned about it. So I think I steered him off of it. I think I steered him in a different direction. Nothing wrong with owning these companies. You own these companies, but we have tried to make sure that you're not overdosing on them in case we do get some big reversal. Okay, I think that made that point. The Magnificent Seven, that's the term that's been thrown around, and that includes Microsoft and Apple and NVIDIA and Tesla and some others. They account for 12% of global earnings. That's the amount of money they make. They amount to 12% of the money being made in global stock markets, but they account for 19% of the entire world's market cap. So they're highly valued. Their $1 of earnings is valued more highly than everybody else's dollar of earnings. It's kind of funny, right? It's a dollar, but nope. Their dollar of earnings is valued more highly. And this will take you back, top 10 companies by decade. In 1985, I was a sophomore in college. The largest company in the United States by market value was IBM. Anybody ever work for IBM? We have some, yeah, we have an ex-IBMer here. I remember that. Next was Exxon. We have any ex-Exxon? We do. One. Ex-GE. General Motors, AT&T, Shell, Amoco, Royal Dutch, Kodak. Anybody remember Kodak? And DuPont. These were the top 10 companies, and they accounted for 20% of the S&P 500 back in 1985. 10 years later, in 1995, I was in Houston by then, we have some repeats from the prior top 10. Notably, IBM is a lot smaller than it was, right? It hit some challenges in the world of personal computers. And look at it, it's still there hanging on, but not for, well, it'll hang on a little bit more. GE is then the largest company. Remember Jack Welch, the lionized CEO of GE? This was his heyday, 1995. He could do no wrong. Continues on here. AT&T, Exxon, Coca-Cola now appears, Royal Dutch, Altria, which was Philip Morris, Walmart makes an appearance for the first time, Merck, there's IBM still hanging on by the skin of its teeth, and Procter & Gamble. But the top 10 have actually slipped back as a percent of the S&P 500, down to about 17%. In 2005, GE still there as the top most valuable company in the United States. Exxon's really got persistence. Microsoft enters the top 10. Citigroup. Walmart, Pfizer, Bank of America, J&J, AIG, and there's IBM still. But it's about to be shoved out. If we go forward to 2015, Apple appears in the top 10. Exxon, look at that, Exxon just hangs out there at number 2, doing its thing. Drilling for oil. Microsoft, smaller than it was. It had antitrust problems and it was slow to come to the internet, and that cost it. In 2015, it was still in recovery mode. J&J, Berkshire Hathaway shows up here, Wells Fargo. Here's GE still there, but barely in the top 10. P&G is still there, JP Morgan, and Chevron. And here we are in 2025. Exxon, gone. GE, gone. IBM, gone. Royal Dutch, gone. It's an almost completely new cast of characters in the top 10, except for Microsoft and Berkshire and JP Morgan. Apple's here. I don't think this is right. NVIDIA is more valuable than Apple, so I don't think this slide gets it right. I think NVIDIA belongs on the bottom. NVIDIA today, as we speak, is up 5% today and has now crossed the $5 trillion threshold in valuation. $5 trillion. In the old days, nobody could conceive a company would be worth $1 trillion and $5 trillion. To make that much money, sell that many chips. Microsoft, Amazon, which announced yesterday the big layoffs, Alphabet, which is Google, Meta, which is, owns Facebook and Instagram, here's Tesla, Broadcom, which has entered the top 10. It also does what NVIDIA does, makes chips, but much smaller, Berkshire Hathaway and JP Morgan. So what's the lesson? Things change. The top 10 today may not be the top 10 and probably will not be the top 10 10 years from now. We can in no way assume that these companies here in 2035, hopefully we will all be there at that time and be here, And when I show you the slide in 2035, we shouldn't be surprised if we see a few of these here, but there'll be some new companies. Don't know what they'll be. But look at that change. Totally different industry. This was a petroleum-driven economy. The cars right here burned petroleum, right? Petroleum. IBM's a notable exception to that. And we are now in a technology world. You can see that from the top 10. International equities. Lots of questions about that, and what you can see is that in periods when the dollar is declining, which is shown by this gray, we actually have seen very common outperformance of international equities. Right? You can see that. And we have had a weak dollar this year. The dollar is down about 10%, and there are expectations that we could see further weakening of the US dollar. And so one of the things we try to do to help diversify you and keep you out of this highly concentrated, not keep you out, but to reduce this highly concentrated area of technology valuation is to add international securities. And we can see that global valuations across several different countries, the United States, Japan, Eurozone, emerging markets, and here's China. The blue, these triangles here show you, this is the historic 20-year range of valuations, and this is showing you that the U.S. is near the top range of its historic valuations, where other countries are not near the top range of their valuations. So we continue to like the international sector because we can get you less expensive securities. And you can see here that in particular industries, that while there is a common discount that occurs in international markets for these industries, the discount's even bigger than it usually is. So you're getting a double discount when we add those to your portfolio. So we're doing the best we can to keep you in a good place of valuation in your portfolio. I don't know. Now I'm going to turn it over to Jaycee, and we're going to talk about how have the portfolios done here in 2025.
Is this on, Catherine? Okay, so with all that, how have our model portfolios done this year? Just a reminder, we did introduce this lineup of model portfolios about a year ago. We have our global set of portfolios, the global core and global market. The core is the value and small factor tilts, and the market does not have those tilts. We have our US only portfolios with the same variations, the core with the value and small factor tilts, and then the market, no factor tilts. And then we still do offer the ESG portfolios in a global and US version.
Any questions about these models here? Interest, or what are they, or anything? What are the factor tilts? Factor is small companies and value companies. We tilt the portfolio towards smaller companies and value companies because for 100 years they have had a tendency to provide some outperformance.
Okay, so year-to-date performance of these models. So blue is the global core, red is the global market. I think that's supposed to be a yellow is the US core, and the green is the US market. So starting over on the left-hand side of our model 0, that's our bond-only portfolios. You can see they're all roughly around the 5% year-to-date range. This is through last Friday.
Pretty good. So if you held an all-bond portfolio, you've gotten 5% this year, right? I mean, it's not nothing.
Right. And as we go up, so we're going up in equity. Model 10 would be our all-equity portfolio. You can see that the blue and red really start to pull away from the yellow and green. So that is showing you how the global markets, so with that international exposure this year, you have really started to outpace the US markets. Sorry, I thought that was a question.
If we held a US-only portfolio for you, this is what you would have done.
Not bad, still about 15%.
Still good.
All equity.
Can't complain about it, but the addition of the international exposure has yielded these returns. Yes, Robbie.
Speaking of bonds, what are your thoughts on buying the inflation bonds from the Treasury Direct this year, given the current rate of inflation?
What are my ideas about buying bonds from Treasury Direct? The question is, what are my views about buying from Treasury Direct? The first observation I would make is that I tried to buy stuff from Treasury Direct a few years ago, and I'll never do it again. It's the worst computer system ever. And like, I bought my son some. They were doing some deal back then where you could buy an extra, I don't know, $10,000 in Treasury inflation protected bonds, and like they lost the password and everything. And so I would never use that system again. We have inflation-protected treasuries in the portfolio for you, and so we'd rather buy it there, where we can trade effectively. That system is, yeah.
Yeah.
Anything else on this? Any questions about this? It's very, very clear that the international component this year, and it was hard for us to stay patient with this because over the last several years, the U.S. market has handily outperformed the international markets. And we kept saying, we understand, we think if we'll stay in our seats, we'll get rewarded at some point when the valuations are realized. And boy, is it happening this year.
Okay, so how have we done compared to our partners? So we put our biggest partners up here, BlackRock, Vanguard, and Dimensional. We are
really small companies, right?
Probably never heard of them.
They make their own model portfolios.
Yes.
And, you know, we put together our own, and we go head-to-head with our business partners about who can make a model portfolio.
Right. So starting again over in the Model 0, the bond portfolios. So we tied right around Vanguard. BlackRock was about maybe 1 or 2% higher in the bond portfolio, and we looked at that yesterday, and that's due to their gold allocation in their bond portfolio.
They put gold into their bond portfolio.
And that's
which we thought was
about
cheating.
50% year to date. Yeah, we agreed. And then, of course, moving up again along with the equity, looking all the way to Model 10 here. So the full equity portfolios, we are in the green there. So, and this is our global core, by the way. This is our global models with the factor tilts. We took the lead there, right over 20% for the year. This is as of the end of September. So outpaced all the partners here.
So the good guys and gals in green are having a good year with portfolios. We want to leave you, if nothing else today, with that understanding. We've done a really good job on the portfolios, and it shows. Mm-hmm. These are among the biggest financial institutions in the world, and we're beating them this year. Won't beat them every year, but we're beating them this year. And I don't say that in any gloating kind of way. I just say that to say we're in this time of worry and concern. We get it. We're doing what we can do to try to make it better, and hopefully we've done that.
So this gives you the breakdown of the equity allocation, so you can see why our portfolios have done so well compared to our partners. We have the lowest allocation in the U.S. component, but we have the highest allocation in the international component. Vanguard is really the only one kind of close to our models, but we still have about probably 5% or so additional on the international allocation. BlackRock and DFA still very heavy in the U.S. allocation, and you can see that at least this year in the performance.
And this is a small commercial real estate allocation we have in the portfolio as well. So we have a heavier allocation to the international this year, and that's our answer for how do we deal with this market concentration in the U.S. market. We give it to you, right? That's not nothing. In a 60-40 portfolio, 30-something% of your portfolio is in the U.S. stock market. But we balance it more with international allocation than these other portfolios.
So this is actually diving into the funds that we use in these models. So DFAC is our U.S. equity fund, and DFAX is our non-U.S. equity fund, so international. And you can see in the red, the international, this is total return, so includes dividends, up almost 31% through last Friday, the international fund. And then of course, the US has still done well, 14%, but you can see there's about a 17% spread between the US and international performance so far this year.
This is Liberation Day.
Yep. This is our bond duration, so the bond portfolio. We are on the left there. So we've kept it pretty short for the past couple of years. And we'll probably talk about the treasury yield curve. Do we keep that in the slide?
I think I'm going to let Jordan talk
Jordan's going to talk about that. So you'll see why we kept it on the short end. Again, DFA is probably the closest to us on the duration, but our other partners are still pretty. This is about average. I would say the 5 to 6 years is about a normal duration, but we've kept it short of the past few years.
Right, everybody's noticed that you're still getting paid quite a bit on the short end, even to hold money market funds, right, and short-term treasuries. And so we've been just trying to take advantage of that and keep your portfolio with a shorter duration so you're less sensitive to interest rates, but you're still getting paid a good amount of interest. We'll see what happens with the Fed. I'm very interested to hear Jordan's remarks this afternoon, because then Jaycee and I are going to confer afterwards and talk about what we think.
Yeah. Okay, so this is the international bond performance, the individual bond performance. So there's some pretty interesting numbers up there. The top two, 15% for bond year to date. That bond is a emerging debt bond, and it is also not hedged to the US dollar, so it's benefited from the weakening dollar this year. The first two, the red and the dark purple up there, are not hedged to the US dollar. And the purple, I believe, is the developed markets international bond.
We've wanted to give you some bonds that are not, a lot of bond funds will hedge their exposure to foreign currencies. We didn't want to do that. We're concerned about the long-term state of the dollar, and so we wanted to give you some exposure to foreign currencies in the bond funds. This took us about a month of research and meetings and so on, because it's not as easy to find as you would think.
Right. Yeah.
But we did it. And look at it.
Yeah. And we did keep in the light blue and the green, those are international bonds hedged back to the dollar, so they've still performed very well, but just not had that same benefit from the weakening dollar. And then down there, I think, what color is that supposed to be? Purple or blue, that is ag, so that is a broad exposure U.S. bond fund, just to compare.
This is the U.S. bond market, basically, right there.
Right.
So you see that our international diversification, big picture has helped not only in your stock holdings, but also in your bond holdings.
Our tactical alternative sleeve we introduced earlier this year, and that is where we put in Berkshire, we put in Bitcoin and NVIDIA. So we just wanted to give you their performance year to date. NVIDIA took the lead here, about 39% through Friday, so probably pushing 40 as of today.
Yeah.
Bitcoin, it kind of tracked pretty closely to NVIDIA until this past month. It's taken a little bit of weakness here, so 18% year to date. And then Berkshire up about 8.5%. So, but what's interesting about Berkshire is you can see Liberation Day or the tariff announcement, how it was much more defensive than the NVIDIA and Bitcoin. And that was really the play there, was a defensive position in the Berkshire.
This is why we have it in the portfolio. It's so defensive. Its capital structure is so strong, and it's a defensive holding. So if we get a problem in stock markets, Berkshire tends to hold up very well. So that's the purpose there. We don't expect it to zoom ahead in a bull market like we have right now, and it's not. That doesn't bother us. It's there for the rainy day.
Some updates from Dimensional. So Dimensional is our biggest equity partner. So the funds we use for your equity positions, they have announced for 2025 that there are going to be 0 capital gains for any mutual funds or ETFs. So proving how just tax efficient that those funds really are. Literally 0.
Yeah. We aim to give you very, very tax efficient portfolios, and you can see 0 capital gains will be distributed from their funds. It's big.
Mm-hmm. And another announcement they have recently made is that they have gotten a notice to approve from the SEC for ETF share classes. What that would mean is if anyone's holding appreciated mutual funds in a taxable account, that we would likely convert you into the ETF, our preferred vehicle, over that time when it's formally approved. No tax to do that, but we just prefer the ETF over the mutual fund.
The ETFs are a little more tax efficient. The mutual funds, the older mutual funds, are very tax efficient. But we have some clients, especially clients who've been with us for a longer period, who have some of the older mutual funds. If they're in a non-qualified account, if we sold them, there would be a tax. So Dimensional went to the SEC and said, we would like to be able to convert those mutual funds to an ETF. They're basically the same funds, but we don't want there to be a taxable event upon this conversion. And the company that had pioneered this maneuver of being able to change a mutual fund into an ETF on a tax-free basis was Vanguard in the early 2000s, and they patented it, the maneuver. And so nobody could do it for a long time, I guess, because of this patent that Vanguard held, except Vanguard. And then the patent ran out, and so Dimensional was the second company to file before the SEC, and that's now been approved. So we'll see how that goes, but a number of you with the older mutual funds, as soon as we're clear to do a conversion, we will do a conversion. Tax-free conversion.
Tax-free, yes. Important piece.
Okay, just a few reminders. We want to remind everybody that the performance of different areas of the stock market changes. The leadership changes from year to year. We're so focused on the Dow, which is a primitive index, and yet it's on every television that we go by in every lobby. It's an index that was created in 1890, and it's primitive, and yet we watch it all the time. And so we're so U.S. focused. But if we take a look at the S&P 500, it's this gray, and you can see that between 2000 and 2004, it had the lowest return of all of these other different stock classes, emerging markets and international and small companies. And then in this period, 05 to 09, it moved up to below middling. Here it's in the middle of the pack. And where did it go after that? Oh, then it spent, right, we know about this period, 2015 to 2025, it topped the charts for a 10-year period, right? But here we are in 2025, and where is it? It's hard for me to see the colors. Is it here?
Right in the middle, 14.8.
Right here, back in the middle. So leadership among stock classifications changes all the time. This is why we give you a diversified portfolio. So we want to remind you of that. We want to remind you this is cash in a 60-40 versus a 60-40 portfolio. The percentage of time a 60-40 returns were positive or outperformed cash from 1995 to 2024. I'm trying to help interpret this. This is answering the question, should I go to cash? Would I be better off holding cash than my portfolio? Well, this says that 1 month on a rolling basis, on a short-term basis, the 60-40 portfolio outperformed cash 67% of the time. On a rolling 6-month basis, 81% of the time. 1 year, 83% of the time. 3 year, 87%. 5, 10, and 13. It's virtually certain that if you hold your portfolio, you will outperform cash.
I think the green is the performance outperformance.
Percentage of time outperforming cash. Okay, the green. Here it is. Sorry. Time that it was positive. So anyway, these are still strongly 80%, 90%, and then 100% of the time over a 15-year period. In other words, there was no period, no 15-year period when cash outperformed a 60-40 portfolio. So we want to remind everybody that it's very, very hard to overcome or to time You know, now we want everybody to hold the amount of cash that you think is the right amount for you. This is a really interesting slide. We get this question, but the market's at an all-time high. It's dangerous to invest. I shouldn't. Well, this is showing that between 1988 and 2024, if you had invested on any day, which is the gray, what your return was in the subsequent 3-month, 6-month, 1 year, 2 year, 3 year, 5 year period on average. And if you had invested at a new high in the green, what your return was. Okay, well, you screwed up. 3 months, 2.4% versus 3%, but it's almost indistinguishable, right? And then look at the 5-year period. Actually, if you had invested at new highs, you had a higher return 5 years subsequent to the investment than if you had invested on just any old day, right? And you can see where highs were established, so-called market floors, dating back to 1950, right? So if this right here or this right here in 1990 or 1995 caused you to say, well, it's a new market high, I'm not going to invest. Look what you missed. While you waited for the market to get back to here, right? Right? Here you are, 1995. I'm not going to invest until I go back through the floor to here, where it is in 1990. When I see that 1990 number, then I'm going to invest. Well, look, how long are you waiting? You're still waiting. So we want to remind people of some of these things. Okay, just a couple of minutes here. Themes for this year: U.S. political levels. Political risk is at very elevated levels. We just don't know what sort of political risk could bring or could materialize and what it could do to markets. What if we have a declaration of martial law in the United States? I don't know what that does to the stock market. Maybe nothing. Maybe it goes up, but it's a risk. U.S. tech valuations are stretched, but AI is growing powerfully. I want everybody to know that there is a reason why this technology is being so heavily invested in. There are good reasons for it. It's been developed by the world's finest scientists. I know that doesn't guarantee anything, but it truly is a remarkable achievement. And we're heading toward an achievement called AGI, Artificial General Intelligence, the belief that there will be a networked computerized intelligence that has a higher degree of intelligence than a human being, reasoning capabilities. And the scientists believe we'll be there 5 years or so. Ned, you track this stuff. It's kind of imminent. Close. And the people working on these things, they're not evil people. They're among our great scientists, and they do have ethical qualms about it, and they state them. So don't think they don't. We are pushing for the broadest diversification, not just broad. We are spending our time always thinking about how broadly can we diversify you. How can we make your portfolio look like a school of fish? So if one day we wake up and our government doesn't like that company, or that country doesn't like our country, we have you very diversified, and you're not a target. And that's how my portfolio is constructed also. I talked about the market climbing a wall of worry, so I want everybody to just take that with them. That's a major theme. Please keep that in mind, that markets do climb walls of worry. And then we want everybody to be vigilant, not exuberant. I want to echo that very first slide we started with earlier, people feeling concern across a variety of issues. We share the concerns, and we are thinking vigilantly and not exuberantly. I I don't particularly love raging bull markets. I like good prices on things, you know. I'm just sort of wired that way. I like when people are happy with what their portfolio is doing, and I know that a lot of people like to log in and see their money going up in value in their portfolio. I'm happy for that. I like that too, you know. But we're professional financial advisors, and we can't chase off after you know, bull markets. We have to constantly be thinking, you know, what's the catch? And we are doing that. We want to assure you of that.
Okay.
Real quick, let's take a look at some tax law changes.
So we did go over this in our last quarterly market webinar, right after they had passed the OBBBA tax law.
OBA.
Yeah. But just some reminders that with this law, there was the extension of the 2017 Tax Cuts and Job Act, federal income tax rates, so they're going to remain at the lower level. Standard deductions as well are going to remain higher. There is a new age 65 and older bonus deduction, $6,000 per person, but there is a phase out on that for your income. So your CPA accountant will be well aware of this. The increase in the state and local tax deductions from $10,000 to $40,000, so that's probably pretty significant for many of us here in Houston who own houses and have property tax.
Basically undoing the caps that were put on in 2017. Remember that? In 2017, when your tax, your home interest, mortgage deduction, and your property tax deduction got capped, they undid that.
Estate tax exemption, I know there was some worry that maybe it would be reduced, but it's not. It's actually going up next year to $15 million per person, beginning 2026. And then the expansion of the 529 education accounts. So there's some new expenses that can be used for professional certifications, licenses, etc. And there is an increased annual allowance for K through 12 expenses, $20,000, I think, up from 10. Charitable deductions, there is, for those of you who have donor advised funds and contribute to that, there is a new 0.5% of AGI floor. It's not a huge number. It's not, I don't think it'll have a significant impact, but it is something to be aware of.
We don't think it stops the logic of making contributions
to
to charitable funds.
But they did extend the non-itemized charitable deduction of $1,000 per person or $2,000 joint if you don't itemize. And then just some things to think about with these changes. Might want to recalculate your W-4 estimated or other tax withholdings for the upcoming year. Reconsider itemizing versus taking the standard deduction. Reflect on any legacy, estate, or charitable plans. Rethink your 529 account uses and review Roth conversions, which we're happy to do with you.
Okay, we are out of time. We're not going to take Q&A right now because we want to get to Sharona. Right, we're out of time, Catherine? Okay.